Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is January 11th, 2024, and we're going to discuss what tomorrow's bank earnings can tell you about what's coming next. To start out with, let's take a look at XLF. XLF is a financial ETF. It's for the financial sector, and it's not just banks here. In fact, let me just show you quickly as far as the analysts have and the percentages and the ratios in XLF. You can see Berkshire Hathaway is accounting for 12.8% of the holdings. JP Morgan is the first bank, and it's about 10%. Visa and MasterCard are not banks. They make their money off of transactions in their network, not off of lending in their banks. Then we have Bank of America, Wells Fargo, SPGI, Goldman Sachs, and Morgan Stanley. So these are all potential things to pay attention to, but we have earnings tomorrow. And we specifically have earnings in JP Morgan, Bank of America, Wells Fargo, BlackRock, and Citi. All those are having earnings tomorrow. Are they going to tell us something early on that we should be paying attention to in conjunction with the economy? So to start, let's start out with the biggest holding in XLF that is a bank and does lending. And the reason why I'm doing this is because lending feeds growth. So let's start with JP Morgan. And if you forget, we can always go back to 2008, 2009. So we're going to go back to 15 years. That's surprising that that is that long ago. Let's go 15 years, and we'll use the weeklies to start. And pay attention to what happened with JP Morgan back. Actually, got to go back 20 years to be able to get to 2008, 2009. Now, when we stopped lending, when the banks couldn't lend and they were leveraged up and the real estate market crisis happened, we saw a peak in 2007. We saw consolidation in 2008 and this huge expansion, higher highs, higher lows, higher highs, lower lows. And then we fell from a peak about 52 down to about 15. This was, for all intents and purposes, a 75% drop and a complete crush of the banking sector. Now, this is too big to fail time and real estate time, but what I want you to pay attention to are these earnings. 68 cents, 54 cents, 11 cents, 7 cents, 40 cents. And so we found that we were losing money as we were making less earnings in the banks. The banks were not lending, so they weren't making profit. 68 cents, 54 cents, and you can see that was going through here. The highest peak, the biggest earnings, was right here. From there, we declined to 7 cents. We didn't go negative, but to 7 cents, and we saw that just liquidate and drop. Then we turned 40 cents, 28 cents, 82 cents. We started climbing, and that was the bottom. That was the bottom of the market. They started making money. And the way I see this is that when banks are lending, people are borrowing. When banks are lending, people are building. When banks are lending, research and development is being done. When people are lending, they're spending on consumer goods and services. And so banks lending and money going out the door of banks is actually a good sign for the economy. Now we can see that was a huge correction, about 70 cents. Now zooming over to today, the type of earnings per share are at record highs. Banks are crushing it. 450, 378, 374, 263, a little bit of a dip there. But 433 as far as earnings are concerned. And we're going to watch to see if this is a major miss. Let me go into the shorter time frame. Let's just do the 1 year daily. If this earnings is a major miss, in fact, what I'm looking for is a 20 to 30% miss in earnings. If that happens, it tells me that banks did not lend last quarter at these higher interest rates, or they're holding on to the money. And don't forget, there's legislation being proposed that would require us to go to a 20% in reserves to keep the banks safe. Now, if we're looking at JP Morgan, let's go take a look at Bank of America, and we're going to stick to these big players and look at some of the data here. Now, not like JP Morgan, not crushing it, 85, 95, 88, 90. So again, if we fall into the 70s and we see this rollover, to me, that will be an indication that we have found the peak in Bank of America, and a good sign that they are not lending. One of the things we want to watch is not just how they're lending and what revenues they made from that lending, but we want to watch their cash flow as they support their company and watch their asset base. So let's do two other things while we're here. While we're at Bank of America, we can say, look, this may have been a top. And if we're down near these lows, if we break down, notice that we're already pricing in a miss. From yesterday to today, we're pricing in a miss, and we could easily drop to 32.62. And I'm betting on a drop to 32. If we close below 32, then we should see a decline down to 30.5. That is a 10% drop in Bank of America. Bank of America, if we want to look at its expected move for tomorrow, we can look and say, look, we're pricing at about $1.12. So if we see that $1.12, we go to 30, 32, and then go down to 30, we're talking about a 10% move, and this is going to be multiple times bigger than the expected move as being priced in by the earnings and for the options. That would be a massive sell-off. If we look at the fundamentals around Bank of America, let's go take a look at the fundamentals on their fundamentals page. And if we're looking at the fundamentals, we're looking at the earnings per share. We already had a dip from year over year. If you look at the earnings, 275, 187, 357, 319. So we've already rolled down on earnings. If this year is worse, if we see this come in sub $3, to me, that's a big sign that we missed earnings, that we're not lending, and they're showing that the economy is not in a growth phase. If we look at the returns on equity, we saw their returns on their equity dropping down from 12.3 to 10.6. And if we look at their assets to equity ratios, that has also declined by about 4%. So they're running out of assets. And as we're looking at this, earnings were fading already, and this could be the second year down in earnings as a big indication that the market is slowing down. Going over to JP Morgan, you're going to see a similar story on their fundamentals as we look at earnings per share, down 27% from the previous year. So 1536, 1208, if this year is also down 20 to 30%, that means that we could see 50% lower earnings in 2021. That would also tell us that they're not getting the returns that they did before. Already a return on equity, 33% less than the previous year. As we look at their margins are down 55%. They are not making money despite the fact that interest rates are higher, which theoretically means they're lending higher. They are not making money. As we look at their assets to equity, again down -4%. We're seeing all of this slide lower. Revenues have been good over the last couple of years. Current trend has been up, and we can see the 3-year average and 5-year average are great. But if revenues slip and earnings miss, and their debt to capital ratios slide and their assets to equity ratios slide, we're looking at a major slowdown in lending and growth. Let's take a look at Wells Fargo. Wells Fargo is not nearly as big, not nearly as important to us, and after their struggle, they certainly are one that we don't watch as carefully. But you can see their earnings per share are worse. 12 months trailing, year over year is down 57%. If we see a similar drop from 495 to 314, we could be approaching 2020 levels of earnings for something like Wells Fargo, which they will also report tomorrow. And also note that their free cash flow was obliterated. They don't have money. They don't have cash flow to defend their position. The last two I want to look at before we wrap up is BlackRock and Citi. Starting with BlackRock, before we even leave and look at the chart, just to notice the trailing 12 months and the year over year down 12%. They are not earning as much. Remember, they're the ones that bought in a ton of real estate. They bought a lot of real estate. And so if they are struggling, if they miss on earnings, could they liquidate some of their assets? As we're looking at their cash flow is fine, but their earnings are way down. If we look at their leverage is getting worse, and their assets to equity are way down too. So not good trends for their revenue, their net income, and the earnings per share. We know rents have not gone up. We also know they have not gone down. For all the investments they've gone into real estate, this is a bad sign for a company like BlackRock. But not nearly as bad for the overall economy as we would see in individual banks. Going to Citi. Citi is going to be our last one as far as our banks go. Again, 45% decline year-over-year earnings per share. Major miss. If we see another $3 drop here, we'd be talking about lower than 2020 levels in Citi. So if Citi is already on the decline and we'll see the report, and if they miss tomorrow, we're looking at a worse than expected additional drop in earnings per share year over year, return on equity year over year, return on assets year over year. All of these are negative year over year, and we could be looking at a second year over year decline. Net income, earnings per share, and dividends per share all sliding lower. Only the revenue has gone up. What does it mean when we see revenue rising but earnings dropping and net income dropping? It means that it costs them more to do what they're doing, and they're making less. As we look at Citi has already dropped down through here. This is a lot of bearish pressure. As we're looking at Citi's bearish pressure pushing lower, tomorrow's earnings could see us go this distance again, which would be about a 80 cents, 90 cent move. If we look at the probabilities here, we're pricing a $2 move. If we go from this level to this level, again, that's about 80 cents. So just double checking. 53.02 to 52. Yeah, about 90 cents actually. And so we've already gone half the move. The next move lower would bring us all the way down to 50. And from the peak to that trough, we're already down 10%. And I do think we could finish off at 48. Again, Wells Fargo is one of the worst ones, the one that's struggling the most. Wells Fargo is holding up here. If they're a miss, if they slide, I don't think any of this will hold it up. We treat this as a double top. We go from 50.5 to 48, and that would be another $3 move, which brings us down to 45. We could erase all of December in tomorrow's earnings. If we look at the expected move, it's about $1.53. I think we could easily get to 45. Now, all that being said, even though earnings could be traded, even though we could benefit from selling premium and taking directional trades, assuming that banks are going to miss and have less earnings, the bigger story for me is if they miss, it is a sign that they're not lending. If they're not lending and they haven't lent last quarter, that means there's no growth next quarter. Because if banks are not lending, that means businesses are not borrowing. It means consumers are not borrowing. And if consumers are already leveraged up and not borrowing, then home builders, tech companies, small micro caps especially, will be struggling because they're not getting the blood flow, the money, the cash flow that it needs to survive into this next quarter. So all of these are on the table to watch very carefully as earnings roll out to see where we're going next. Well, that's going to do it for me today. Have a great day. We'll look forward to seeing you after earnings tomorrow and talk to you again next week.